Good morning, everybody. Hopefully you had a wonderful weekend. I've been enjoying the summer. So we've got some fun stuff to cover today I think that you'll find helpful. So get started here. 5Q breakdown last week was a snippet of the power of attorney. The advisor does a great job making sure the client is having a good time, but what could he have done better? So remember, this is a great way to really start to hone in on those 15-minute drills by listening to these breakdowns every other week. Till sent this in. I thought it was a good article, so thanks, Till. Advisor explains how a single document can reap huge rewards. Several years ago, Russ Story of Wealth Management Group in Douglas, Georgia, met a husband and wife through financial seminar. He conducted still a relatively small family-run boutique firm, blah, 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 blah. The husband and wife fit that profile for being clients. When the husband died, his widow, a retired teacher, remained Story's client. 8 years later, she became terminally ill and her health deteriorated to the point where she was completely dependent on a ventilator. And her sons, her only heirs, were in sharp disagreement over whether or not to continue her medical treatment. So what can help with this, guys? When this happens, what can help? What do we talk about, the thing that can actually tear a family apart if they don't have it? What's that document? Yeah, everybody's getting it. Quality of life directive, exactly right. It's not the medical power of attorney, but the quality of life directive, right? So, so this advisor actually had a quality of life directive. The brothers' disagreement became so intense that one of them called Story on Saturday morning. The widow had only a few days to live. Remember, the sons didn't want to suffer unduly in the end, but they couldn't agree on the course to follow. A decision had been made. Neither the son could recall discussing the end-of-life option with the mother. Story knew exactly what to do as part of his standard intake practice for clients. He had asked the parents to create a health care directive at the very beginning. The couple had cooperated, was glad, and it was completed, citing the peace of mind it provided. It was actually the woman's request that I keep a copy of her health care directive in my office instead of just storing it with family lawyer, which is customary. This turned out to be a prudent decision when Story received the panicky call. I immediately went to my office, found a copy of the living will, which I faxed to the son. It explained all her final wishes, and she stated that she wanted to be comfortable but not kept alive by artificial means. The document was pretty clear. It quickly settled the dispute with the sons, who were relieved to be able to honor her mother's wishes. The ventilator was removed. She died 2 days later. When I attended the memorial service, the sons expressed their gratitude to me. They were beneficiaries of the state, and they kept the assets with me. Now, let's talk about that. What percentage of, in today's world, what percentage of sons or kids keep the assets with the advisor when the parents die? What percentage? David says 20. Glad says 0. It's somewhere in between. There's about 92% of people with 92% of kids leave. 92% of kids leave their parents' advisor. So this guy beat the odds easily by keeping those sons. So in time when the son died, the other remains Story's client today. The lesson is Story is reflected as the single document that can reap huge awards. It allowed a widow's final wishes to be realized. And guys, I had all of my clients' documents, all those documents that I asked them to do with the 21-point checklist, is I had them in the office. And I was basically the first person that those kids always called when something happened to mom and dad, because the mom and dad said, just like this lady said to her about her advisor, that's what my client said about me. You need to call Mike if something happens. He has all of our documents. So this is a great example of why what we do can really change people's lives, and it's a great example of, by changing people's lives, how it can benefit you. I mean, that's the power of doing those non-financial things. I love this little cartoon that I saw. It says, just do nothing. It is impossible. So what do you think the punchline to this is? Anybody know what the punchline to this is? Just do nothing. Just do it. Nothing is impossible. So when guys tell me something is hard, really, guys, any of the things that we do hard, is learning the scripts hard? Would you classify that as hard? How many people in the world would like to get paid what we get paid to memorize a script? No, it just takes time. That's right, Dave. It just takes time. It's not hard. It just takes time. And if you know, with my kids, I always said, if you don't do well in math, I can understand that, because math requires, you know, not basic math, not basic addition, subtraction, multiplication, division, but like higher math, like calculus or something like that. Sometimes you don't get it. That's a concept, and it's a theory, and you might not be able to get that concept theory. So I can understand you do your best, but I can understand if you don't get an A. But if you don't get an A in English or history, that's what? That was due to lack of what? Lack of effort. Because there's no theory in history. There's no theory in English. You basically can, if you spend in enough time, you're going to learn it. So I just do it. Nothing is impossible. Mike, it's so hard to ask open-ended questions. We've talked about that. Is it really hard to ask open-ended questions? We talked, I think, last week or the week before. Could I fix everybody's problem about asking open-ended questions? Could I fix everybody's problem? Let's see how many of you remember. How can I fix everybody's problem with open-ended questions? How can I make sure that nothing comes out of your mouth except an open-ended question? How can I do that? That's right. Sitting in the corner of your office with a 45, and I say, I'm going to shoot you in the knee anytime something comes out of your mouth other than an open-ended question. Presto, change it, fix. It's not hard, is it? Just required your 100% focus on doing that thing. So I love this. We can either say, just do nothing, it's impossible, or you can say, just do it. Nothing is impossible. Change of mindset. That's right. Change of mindset. So today we're going to talk a little bit about fees, and the fees we're going to talk about is money management fees. So are money management fees good or bad? Money management fees, good or bad? Neither. Yeah, that's right. They're neither. Or both, either one. They're neither good nor bad. Now, what do we have? What's the 21-point checklist advantage when it comes to money management fees? If you're an RIA, what's the advantage you have with the 21-point checklist when it comes to money management fees? Transparency, I go along with that, Till. What else? Kevin's got it. Everybody's got good answers here. You're all giving me good answers. But Kevin brought, I think the biggest thing is we add more value. With the 21-point checklist, what can we tell them about our fee? That it's only for managing money? With the 21-point checklist, are we saying that they're only paying us a 1% fee for managing the money? What do we say that 1% fee covers? All the things that we do with the 21-point checklist. So that's the advantage, because if you're judged just based on the fees, what is every magazine article telling them? What is Charles? I just watched Good Morning America this morning as I was having my coffee, and Charles Schwab is on there. What's the Charles Schwab telling their folks? It only costs $4.95 to invest with us. So if we're only charging fees for money management, what's going to happen? There's already pressure on fees. What's going to happen to your pressure on fees? So it does give us that advantage. We have more value. And when it comes to money management, what are the only three things that we should be promising to people? Should we be promising, hey, my money manager's really got it figured out. He's the best guy out there. Should we ever say something like that? How do we know our guy hasn't got it figured out, that he's the best guy out there? How do we know that? Well, we do know he's not the best guy out there. How do we know he's not the best guy out there? Yeah, who said that? Nick's got it. Because we can afford him. If he's the best guy out there, how many people would want to be with him? Everyone. Could he take everyone? No. So what would his minimum account size be? $1 million? Give me a freaking break. In today's world, is $1 million a lot of money? Yeah, 100 million. $1 billion. That's what his. If he was really that great, that's what his minimum account size would be. So the fact that he's working with us, the fact that he's working with our clients, means that he's not the be all end all. It means he's good. It means he's good. He's not bad. He's good. He's not the best, but he's good. So there's only three promises we should make. Should we ever promise him that, you know what, my guy's got to figure out he's going to protect you on the downside. You're never going to get all the upside, but he's going to protect you on the downside. Should we ever make that kind of a promise? Yeah, David's got the right answer. No, unless you're willing to what? Bet your house on it. Are you willing to bet your house on it? On the fact that he's not going to go down as much as the market, and when the market goes up, he's not going to get quite as. You're going to bet your house on that? If you're not going to bet your house, then don't say it. But there are three things that you can say when it comes to your money manager that you can bet your house on. When the market goes up, your money manager sure in the heck better what? When the market goes up, your money manager sure in the heck better go what? Up. And when the market goes down, their account's going to do what? go down. And historically, the market has gone more what than what? More up than down. So this is, and again, I'm talking about money managers here, not FIA. So somebody said when the market goes down, it goes sideways. I hope you're talking about an FIA when we're talking about when the market goes down, it goes sideways. Because is any money manager going? Okay, so they're saying yes. Okay, good. Yep. So when this is for money management here. Now I came across an article, and I thought it was pretty interesting. And you tell me whether this is the way. I mean, if this is some weirdo out in La La Land that's saying this, or is this the kind of information that our clients are being bombarded with every single day? So just what does that money management fee cost you? Beware of little expenses. A small leak will sink a great ship. Benjamin Franklin. So let's look at two couples, the Smiths and the Jones. The Jones thinking that they have to keep up with everyone else who has their surname, think that they're better off going with an investment professional who's going to charge them 1% of their investable assets every year for the privilege of working with them. Said professional matches the market performance, save for expenses within funds, and 1% annual fee. The Smiths decide they're going to throw caution to the wind, do it themselves. They invest 60% of their money in the S&P 500, and they invest 40% in a bond index. Okay. So since we know that past is only somewhat indicative of the future will look like, I created 10,000 different potentials futures for the Smith-Jones to see how much of an impact AUM fees would have. Both families earn $30,000 after taxes, and $5,000 of that money and their earnings, spending, and investing all matched inflation. Over 30 years, they retired and lived off their investments for another 30 years before passing the great beyond. How did each family do? Guys, do you think that the difference is going to be on a 1% fee versus no fee? How big a difference do you think this is going to make? Yeah. So in the 10,000 potential futures I modeled for the Smiths, who did it themselves, just the 60-40 portfolio using the S&P 500 and a bond index, their average net worth was putting $5,000 in per year. Their average net worth at their death was $2.63 million. 50% of the time they had more than 1.3 million. 50% of the time they had less than 1.3 million over 60 years. So you understand that was saving at $5,000 a year and then retiring and then spending that money. So that's where they ended up. 50% of the time they were over 1.3, 50% they were under 1.3, and their average net worth was 2.63. So 70% of the time they departed this earth with money in the bank. Comparatively speaking, the Jones were worse off. This is not surprising since I never gave the portfolio manager a chance to outperform the market. So you're saying, hey, the manager averaged the same thing as the market did. So is he really being mean to managers here, guys? If he said the manager is making the exact same amount as what the market is, yeah. So this is, after all, an exercise to demonstrate the actual cost of how much money manager needs to outperform the market, rather than a model to show rare times when lightning strikes and the manager is extremely lucky, since it requires luck to outperform the market over time. Managers historically significantly underperform the market. The Jones had a mean net worth of 813 versus 2.63. 813 versus 2.63, and 50% of the time they had more than 104,000, and 50% of the time they had less than 104,000. How is that compared to 1.3, 104? 1.3 was the mean, 104 was the mean. How much did those fees kill the advisor? I'm sorry, the people. Now, for those of you that say, well, my money manager is better than, is going to perform better than the market. Well, it says report from Standard & Poor's. So Standard & Poor's hate stocks, right? Standard & Poor's hate stocks, right? No, that's their whole business. So a report from Standard & Poor's shows that 74% of active managers in U.S. equity funds underperformed the market over the past 3 years. The other report shows that less than 5% of all top performing funds remained in the top quartile 2 years later. For those 25% that did outperform the market, only 5% of them, which means only a fraction of the total 100%, right? Because not 5% of 100 is 5% of that 25%. Remained in the top quartile then 2 years later, which means what? You have to take more risk to beat the market or less risk to beat the market? Yeah, more risk. The S&P 500 latest reports all but prove that blindly turning over your money to an active money manager is also a bad idea. Most active managers underperform the market, and this is Forbes. Most active managers underperform the market in any given year. Those few managers that do outperform in 1 year are unlikely to repeat the feat the next. Betting on which manager gets lucky in any given year is not smart investing. This is Forbes that's saying this. So are our clients seeing this kind of stuff, or do they have their head in the ground? They're seeing this kind of stuff. The difference in performance is stark. The average Smith died $1.82 million richer than the average Jones, and 50% of the time the Smith family died was $1.27 million or richer than the Jones family. Because of the AUM management hamstrung the Joneses heavily in the wrong times in some of the model futures, on average, he had to outperform the market by 8.3%. They would have not by 1%, by 8.3% in order to keep up with the Smiths. A more realistic number in the median, 50% of the time, he had to beat the market by 1.67 or better to help the Smiths. So there's a bit of the Simpsons paradox here, which is here in the middle. A little under 24% of the time, the AUM manager, despite charging 1% every year, doesn't have to perform. So 24% of the time, they don't have to outperform the market by more than 1%. This happens when the market goes up a high amount in the first few years, which again, we're counting on the market going up a lot the first few years so we get that sequence of returns. The 1% he charges is relatively small in those scenarios, particularly if the market then underperforms subsequently. So the amount as a proportion of the overall performance, he wins to decrease, but don't count on this happening in your situation. He still has to outperform the market 3/4 of the time. How many managers are going to outperform the market 3/4 of the time? In best case scenario, he's saying best case scenario. This is the best possible scenario. The guy's still going to have to outperform the market 3/4 of the time. How many of our managers can do that? Now, of course, the AUM community won't like these findings. Here's what they'll say, and they'll be wrong. We outperform the market sometimes too. Sure, they do. Most of the time, as documented above, they won't though. When they don't, the underperform performance and the fee will create even more of an anchor. If he'd modeled their own historical performance compared to simply taking competitive in the market, the results would have been even worse. This article puts them in a better light than most of them deserve. So this is not trying to hammer managers. This is giving them the benefit of the doubt, and it's still looking this bad. So why does the monkey brain think public knowledge? You know, because the only way you can beat the market is if what? What's the only way you can beat the market? These managers that say they're beating the market, how are they claiming to do that? With the magic wand? Yeah, well, I agree with you, David. David says insider trading, which we know they're not. But what are they saying? They've got what? Maybe not inside trading, but they got the inside track. They've got information. They got a system. They've got better research. They can see things other people can't see. So this same author says, why does the monkey brain think public knowledge gives them the insider trading? Because guys, is anything now? I understand back in the 50s and 60s, did certain people have access to information that nobody else had back in the 50s and 60s and 70s? Is that the case anymore? Does anybody with the kind of computer power that people have, is there anything out there besides insider trading, which is illegal? Does anybody? So this guy's giving, Jason Hull is giving an example. He said, I saw this ad from Motley Fool, headlines, 3 banks to buy, 1 to consider. This is 53 minutes ago. 3 banks to buy, 1 to consider. I'm glad that I shaved my head because if I didn't, I'd start pulling out my hair. Because don't get me wrong, I like Motley Fool. They have some great advice here. I read the Motley Fool Guide to Investing or whatever it's called with the picture of the 2 founders dressed up in jesters, the way they came out. Their advice is pretty foolish with a capital F. Still, headlines like this just make me cringe. I'm still not calling the Motley Fool out on the carpet. I include them in my ultimate guide to daily finance. He's saying, hey, I like the Gardners. I like what they have to say. But he calls them for a reason. And he says, I'm calling out all the media. And this guy, Jason Hull, who wrote all of these articles, this article here, except for the Forbes article, he wrote all this. He has an article in the U.S. News and World Report. So he's calling out. So there's a hand in my mouth right now that I'm biting because he's saying he's part of the problem for putting out articles like this. So why is, even though he knows this is wrong to do, even though the Gardners know this is wrong to do, why do they do it? They have to claim they have inside, unbelievable knowledge because that's how they sell subscriptions. Exactly right. For putting articles out there like this that give people the impression they have some sort of insider information or they have some sort of system or way to look at things that will get rich by having a stock tip. Newsflash, you won't get rich off of investing on insider angles or stories. The market might be irrational, but it's pretty efficient. If there's a strength or a weakness of a particular sector, then chances are excellent that it's been sniffed out already before the Gardners found it and put together their ad to put it on put it on the internet. There's not an odd cash flow statement that some analyst sees that nobody else gets to see. Your information advantage is 0. So this is when they put out that these banks had they've got this great advantage over these banks. This is where they put it out. What happened? What happened to the stock almost immediately? This is in minutes or in hours here, hour. As soon as they put out that information, did the stock go up or did it go down? No. They put this, so Kevin's got it. This is where they said these are the banks to buy. Where were the price on these banks when they said this is when the ad came out, when it hit your email? This is where they were. What happened to it immediately after it? No, it went down, guys. It went down. Most of you are seeing this, but some of you are still saying higher. It went from here to here. Is that up or is that down? The minutes after they put that on the internet, it went from here to here. Is that up or down? So what was happening prior to them making those, calling those banks good places to buy? There was a run up. This one, it tanked and then slowly came back to the same place. This one tanked and did it ever get back to the same place when they said this is a great stock? So there was already a run up. These are the daily charts for both stocks. Did the stocks both rise the moment the director decided to hit the button? No. But there was a run up before they were recommended. It's called the Kramer effect. So why do we think, why do we think we can use information to give us an advantage above the average, ordinary, everyday Joe? Monkey brain victim to a bias called attentional bias. It's, as Yale's Dr. Trude Allison explains, the bias which occurs when you focus only on one possible outcome rather than focusing on all the possible outcomes. In this situation, I described at the beginning of this article, falling victim to attentional bias would mean that you would only be envisioning buying the stock before anyone else figured out that that stock was a great buy. Guys, is that the case? By the time the Gardeners put that stock out there, really, are they and you the only people in the world that think that that's a good stock to buy? Yeah. You'd write it to the top, and then when you'd presently be able to determine the highest price that stock would ever make, and then sell it right before the peak, taking your money and moving to Tahiti to drink umbrella drinks. Is this what all the money managers, all the money newsletters tell you is going to happen if you follow their advice? And guys, any of you that are looking at a newsletter, do look at reviews of that newsletter. And what are you going to find out about all the things that they say their stocks can do? That their portfolios, yeah, you're going to find out it doesn't work. When you just say whatever newsletter is trying, whether it's the Foolish newsletter or any of the other newsletters out there telling you that they got to figure it out, just Google review their newsletter review, and you're going to find out people that have actually there are entities that do these actually invest exactly in what they say, and they'll tell you exactly what you make. And guess what they find out? That these newsletters do what? They talk about the stocks that went up. What do they not talk about? The underperformers, exactly. The underperformers. So you'd fail to consider all the other possible outcomes, like maybe I'm the last sucker in, or maybe it's actually a good stock recommendation, or then the banking sector collapses and the CDO. What if happens is a good stock, just like Gardner says, is a good place to be, but then the Fed does something or the banking sector collapses and then everything dries up. Instead of looking at the range of outcomes and weighing the probability of each of the outcomes, you focus on one, the best outcome, and mistakenly give it a 100% chance of succeeding. In order for you to succeed in this type of plan, the market would have to be both irrational and inefficient. Is the market both irrational and inefficient? It's irrational. Nobody's going to argue that. It's irrational. But is the market any longer inefficient? It was in the 50s. It was in the 60s. It was in the 70s. But with the kind of information that's out there now, is it inefficient or is it truly as efficient as it could possibly be? Within nanoseconds of somebody knowing something, what does everybody else know? So rational markets would mean that the market would be undervalued compared to what would be based on the business outlook. Inefficient markets would mean that the information is not rapidly incorporated in the stock price. I'm a firm believer the markets are irrational, as investors are human, and all of them have monkey brains running around with their heads suggesting investments. However, I'm a firm believer the markets are efficient. So this is why it's impossible to beat the market on a regular basis. And that's why it's so important that with the 21-point checklist, when you're charging fees for money management, that you use a 21-point checklist, because you're never going to beat the market. You're never going to find a manager who is the be-all, end-all. Hopefully all the managers you're using are good. They're good, but they're not the best. So how can we leverage this fact with us, with our clients? Well, the fact that we are transparent, that's a way to leverage it. And then we leverage it with the fact that we now, with the 200-point checklist, say we're charging more for fees. We're charging more for fees because we're charging the fees because we're doing all these non-financial things. So overall, our fees are not very expensive. But the way we really leverage it is when we do what? What's the way we leverage fees the most effective way with the 200-point checklist? We have them realize that what? That's right, Mark. We have them break it down for themselves and find out what their advisor is charging them. So let's look through how we do money management fees. How do we do money management fees? First thing we always do is we say, do you like things sugar-coated? Because this is where we're done with the non-financial stuff. We're about to get into the financial stuff where they find out this guy withheld information from me because if I'd known this information, I would not have invested the way I did. And if I hadn't invested the way I did, he would have made less money. He didn't accidentally forget. This guy did it on purpose. He withheld information that if I'd known, I wouldn't have invested and he wouldn't have made money. So he withheld it to make money on me. So that's why we have to do the whole sugar coated. We're about to give them, show them that the guy is actually stealing from them. So before we do that, I always make sure you ask that sugar coated so that they say, oh, sounds like some bad. I've already had a lot of bad information, but sounds like some worse ones coming. I need to be prepared for that. So that we do that. Now, why do we do the gas story? The fact that what kind of well, first of all, so why do we do the gas story? It's a third party. It's not about their investments. It's a common sense type thing. How many people check the gas prices? And if there's two across the street, one across the street from the other, how many will go to the one that's even 1 cent cheaper? How many people go to that one that's 1 cent cheaper? Yeah, a lot. Most of them. Also, how many people buy gas? How many people can relate to gas? See, I don't use golf because how many people golf? Everybody? No. But how many people buy gas? Anybody that has a car, guess what they've done in their lives? Buy gas. Now, the reason I start with a third-party story is because is anybody going to argue that if one gas station is charging not 1 cent more, but 25 cents more, now what will everybody do? They're across the street from each other. One's charging 25%, yeah, they'll all get the cheaper gas. Is anybody going to argue with that? Is anybody, when you do that story, going to say, no, I think I would pay the 25 cents more? How many people would say that? Nobody. And how many people would be angry if when they ran into the guy who charged 25% more, they said, listen, here's why I charge 25% more, or 25 cents more. It's cleaner for the environment, it's better for your car, and it's going to get better gas mileage. Now, would some people buy the 25 cents more? Not everybody, but would some people say, well, it's cleaner for the environment, it'd be good for my car, and it's going to give me better gas mileage? Yeah, some would. Now, what would happen if they found out that that guy was lying and the exact same gas is being loaded in the tanks of the one that's 25 cents cheaper is the one that's 25 cents more? How many people are going to be pissed off? Most or all? All. Not most. Who would not be mad that the guy basically lied to their face about that? Everyone. And will anybody see? Is it about their investments? Is this story about their investment, or just about common sense? Hey, we all want to save some money on gas, and anybody lied to us, we'd be what? Pissed off. Common sense. See, the reason we do that is then, if we agree that's how we are in real life, when we get to their personal situation, can they say, yeah, I would be that way everywhere in life except when it comes to my money. Then I'm going to be stupid. Will anybody admit that? But if you go right for their money, will people say stupid things and defend themselves stupid ways when you go right for their money because they don't want to look like an idiot? I do. And I saw lots of clients that do that. So I need to remove that from them. We need to talk common sense, not about them, not about their investments. The common sense stories are about me or some fictional person and something that they do every single day that has nothing to do with money. Do you get that? Do you get that? That's why we have to have that story. It then it prevents them from saying that they would do that with their money. They wouldn't do that for a 25 cent per gallon fill up on gas. Are they going to do it with their $800,000 portfolio? They wouldn't do it with 25 cents on gas. How are they going to do it with their $800,000 portfolio? No. See, it prevents them from saying foolish things. Now, we have to go through that whole best manager thing with them. And why do we do that? Because what have they been told about their manager? That somehow he's got it what? What has their advisor told them about their manager? If he's got it figured out, he's got this system, he's got a algorithm, he's got a whatever. So we have to go through and have them admit to themselves, if there was really a best manager, if there's really a best manager, how many managers would there be out there? One, yeah. And how many managers are there out there? Thousands. There are thousands of money managers out there. And if he was really the best manager, how many, what do you think his minimum client size would be? Because if he can't work with everybody, so if he's really the best manager, do you think the wealthiest people in the world would want to work with him? If he was the best manager, do you think the wealthiest people in the world would want to work with him? And do you think you'd rather work with somebody with $1 billion or somebody with $1 million? So don't get me wrong, $1 million is a lot of money. But this guy can't work with 600,000 people. He's going to work with just the people that can afford him. So if that's the case, is your manager the best manager or is he a good manager? So I'm not going to say they're a bad manager. I'm going to say, is he the best manager or is he a good manager? He's a good manager, yeah. Because if he was really the best manager, how long, if he's beating the market on a regular basis, how long before everybody would figure that out? How long would it take for people to figure it out? Everybody move their money to him. Not long at all. So your manager, hey, don't get me wrong, your manager could actually beat the market for a couple years, but if he had done it for more than a couple years, again, how many money managers would be out there? Or would your guy be the only guy available? See, why do I have to get them to admit that their advisor told them that their guy had it all figured out? Why do I have to get them to admit that? Because otherwise they're going to believe that their guy, they have to think logically. They have to think with common sense. There's no way my guy could be as good as my advisor told me, or he'd be the only manager out there. They see, common sense says that cannot be the truth. I have to get them. Now, have I mentioned their money yet at this point? The gas station and the best money manager. Have I mentioned their money yet? No. Now, but I've cut off their legs here. Now I'm going to go for, that's what concerns me. That's what concerns me. Because of the money that you're paying. And I'm going to go right then into the risk-reward script. Jump to the risk-reward script. Why am I going to go in the risk-reward script? Does anybody know? If I'm paying a fee, what do I expect? If I'm paying a fee, what do I expect? Yeah, results, something, results. Could be higher returns, something back. I think that's best said, something back, results, something. So I go into the risk reward because I'm going to show them, first of all, I have to get them. Do I have to get them to admit that Morningstar third party is a great thing? Do I have to get them to admit that third party is a great thing? We wouldn't look at anything without third party. Then I get them to recognize that Morningstar is a great thing. And then I'm going to go into the graph. So what do we call this line on the graph? What do we call that line with them? See if, Nick's got it. Come on, guys. What do we call this line? Don't tell me Nick's the only one that knows what we call this line. Okay, Mark's got it. Good job, Mark. Marcia's got it. Bonnie's got it. Okay, now a lot of people are getting it. It's the autopilot line. Why do we call it the autopilot line? Because this is the S&P 500. If I go into the NASDAQ, will it have a higher risk and a higher reward? If I go into a benchmark NASDAQ, will it have a higher risk? Okay. So if I go into a bond portfolio, will it have a lower risk and a lower reward? So this is basically saying it's indexes, right? Index with less risk and less reward. Index with higher risk and a higher reward. So how much does it cost in today's world to buy indexes? In today's world, nothing, zero, zippo. And is there any management going on with an index, essentially? No, there's not. So here's and I took this story out. So I'm going to take a poll and to see if you guys want me to put this back in the script. Again, by this point, we're just going for the numbers, for the math here. And we've already done the gas story as a common sense third party. But here's a third party story I took out, and I want your poll on whether to bring it back in. So the way I would describe this autopilot story is that, obviously if you're not paying somebody to, if nobody's driving, if nobody's doing anything, then how much are you going to pay them if they're not doing anything? How much are you going to pay them to do nothing? So that's the way we use the autopilot line. What I used to do is do this. Before I even got into the autopilot line, I would have a third-party common sense story, just like I did with the gas station story. I would say, so let's say if you moved into or let's say your kid moves into an apartment, and they say, and that apartment building has free cable TV, 60 channels, crystal clear, part of the rent. Don't even have to pay for it. 60 channels, crystal clear. And then the cable company calls them up and says, hey, we'd like to have you buy our 40-channel cable package, and because we're a secondary provider to your building, you won't receive quite the same reception. What would you tell your child to do? They got 60 free with the rent, no cost, 60 channels, crystal clear, and the cable company is trying to sell them 40 channels, which is less than 60 channels, and not crystal clear. It's going to be, the signal's going to be degraded somewhat. What would you tell them to do? What would you call your son or your daughter if they went ahead and bought that 40-minute package for more with less? Yeah, crazy. So, because if I'm paying for something, I should what? So if the cable company said, listen, you're going to charge, instead of free, we're going to charge you $60 a month, and you're going to get HBO, and you're going to get these premium channels, and it's better reception, would there at least then be a reason to pay more? So if you get more, you're willing to pay for. Now, whether they would do it or not, depends how thrifty they are. But at least then, would it make some sense for them to go ahead and do that? Yeah. So let's look at this graph. So then I'm going to go have them describe the graph. So this just says low risk, high risk. So that means if we're on this side of the graph, we're going to be low or high. On this side, we're going to be high or low risk. So I'm not going to do all that with you today, but I'm just trying to show you the power of a third-party story. So this is the autopilot line, and I'm going to go through and describe that it's benchmarked, less risk, less return, S&P 500 in the middle, high risk, high return, and that's why we draw this line here. So that means you would have to, this is like your cable TV or the cable TV for your son and daughter. This is free. It costs nothing to do this. This is what you would expect. It costs you nothing to do this. So if it costs you nothing to do this, and instead somebody's charging you more, you would expect what? More or less if they're charging you? If you can get something for free, would you expect more or less? More. More. And there's a couple of ways you could get more. One is you get more safety. One is you get more return. And if you've got more safety, depending on your the way you view life, the way you view your investments, would you pay for more safety possibly? Would that be something you guys would pay for? Yeah. Would you pay for higher returns maybe? Would that be something you pay for? Yeah. And that's what this graph is showing us. So if we want a higher return with less risk, it has to be above this line because, for example, number 10 here is taking more risk. Is it closer to the left or the right? Right. So it's taking more risk. Taking more risk here, but is it getting more return? Is it getting more return than just the index would get? So is that an okay thing there? Is number 10 an okay thing? Are they getting something for the money they're paying? Everybody answer that. Yeah, they are. Yeah. But the rest of these are what? Are they getting anything for the money they're paying here? Or are they getting more risk for less return? More risk for less return. More risk for less return. More risk for less return. Now, what did we say about our kid when they were offered a free investment? When they were offered a free investment, a free 60 channels of cable TV that did not have to pay a cent for, that gave them crystal clear performance, And when the cable company called and said, we're going to give you underperformance and charge you for it, what'd you tell them? What'd you tell your kids? They would be what? So what are we seeing right here? Your investments or your cable TV, are you being charged? Are you getting charged anything for this? We just saw what the fees were. Are you getting charged with this? How much are your fees that you're paying per yearly basis? And what are you getting for that? What percentage of your funds are netting you a higher rate of return for less risk? So what do you think you should be doing at this point? So, okay, now out of role play, what do you think about me adding that? Does the cable TV story help them focus on why it would be silly to have funds that were underperforming this autopilot line? Does it help, do you think? Should I add that back to the scripts? So I'm getting lots of yeses. Okay, so I'll work on that this week and add that. Because would anybody argue with that cable TV story? And is it pretty parallel to what's happening with their investments here? Because 60 channels of free TV, free cable TV, crystal clear. Isn't that basically an index investment? It's free of charge. They can invest in index with no cost. So if you can invest at no cost, you're darn well better sure if you're being charged. Where should all their funds be on that line? They better get something for it. Does that make sense? So now, if any of you money managers are thinking, well, maybe my money manager looks like this. So Jeff, what would you tell one of our advisors? Like, well, I can't really show this graph because if I put my money manager on this, it would look like this. What would you tell them, Jeff, if that's what their worry is? If one of our advisors is worrying that their money manager would look like this on a risk reward scatter plot, what would you tell them? Yeah, some people
Get
are
another money manager.
The right answer. Yeah, that's what everybody's saying. Find another money manager. Find another money manager. If you can't find another money manager, are there techniques where you can use? Are there techniques where you can use the indexes and have a great story while using the indexes on why you're charging them a fee? If you don't know if you don't know those stories, I'm sorry, Missy, I'm going to do this to you because Trish is gone. If you don't know those stories, I'm going to do it to you anyways, Missy. Though you know I always apologize, but I do it anyways. So if you don't know those stories, send an email to Missy, and sometime in the next 2 or 3 days, she'll send you the email with the techniques that you can use indexes and still have a good story on why it would make sense to pay you a management fee. So if you send that email within the next 2 or 3 days, giving Missy plenty of time to get back to you, we'll get you those different techniques. In fact, Missy, can you get on the call once?
Yep, I'm here.
You're using one of those indexes and have been for years, haven't you? One of those index techniques that works quite well.
It works awesome.
So So guys, there's ways to still do indexes, and if that's the case, where are all your funds going to be on this? Right on the line. You don't want on the line is okay. Being below the line, not good if you're charging fees. Yep, makes sense. So I'll work on getting that script redone with the cable TV script. I don't want to make things more complicated for you, but everybody said yes, they wanted that script back. So I'll put that script back in there. I think it's very hard to argue, and it's great to start with a third-party story before you get into their actual monies. So guys, it's summer. It's summer. So when you've mastered those crib notes and motive, when you're doing your daily practice at 15-minute drills, there's no excuse not to do that in the summer. Watching those 5-minute money makers and breakdowns every week, that's when you're going to bring in all and every client you want. So is it okay when I bring in some theory and go into more verbiage from articles that I think we can benefit from? Is that okay when I do that? I know it gets boring with all those words on the page and reading word for word what it's saying, but if I find an article that's valuable, is that okay? Okay, everybody's saying yes. Good. Thank you. I try not to do that very often because that would be painful on Monday mornings, but occasionally I find something and they're saying it better than I can say it, so why not go from the horse's mouth? You guys have a wonderful rest of the week, and we'll talk to you all next Monday. Thanks, everybody.